Since last October, public Bitcoin miners have dumped more than 15,000 Bitcoin from their treasuries. The coins, some of them swore that they would never sell. BitDeer liquidated its entire holdings down to zero. Core Scientific is planning to offload almost everything it has left. And Mara, the largest Bitcoin holder among public miners with over 50,000 Bitcoin on its books, quietly updated its treasury policy this year to permit discretionary sales for the first time. These are the companies that produce Bitcoin. So why are some of them now selling it as fast as they can? Well, because they found something more valuable to do with their electricity. For about 2 years now, Bitcoin miners and AI data centers have been fighting over the same thing: permitted, grid-connected, high-density power with industrial cooling. And in late 2025, the AI side started winning with decade-long contracts and margins that Bitcoin mining just cannot match. So the question that we're really trying to answer here isn't just, will AI kill Bitcoin? It's whether this actually threatens the network or, on the contrary, turns out to be the best thing that could have happened to it. Okay, so to understand why all these companies are pivoting, you need to see how brutal mining economics have gotten since the April 2024 halving. The halving cut block rewards from 6.25 to 3.125 Bitcoin overnight, and that might have been fine if Bitcoin had stayed above 100,000. But as of early 2026, it's sitting around 60 to 70,000, roughly half of the October 2025 all-time high. So you've got half the block reward and half the price. Meanwhile, the cost to produce one Bitcoin is somewhere around 80 to 90K. So most miners are now spending more to mine a Bitcoin than that Bitcoin is worth. Now there's a metric the industry uses called hash price. Basically, how much a miner earns each day per unit of computing power. In February, it hit an all-time low of about $33 per petahash. In practice, that means a brand new mining rig would take over 1,000 days to pay for itself, longer than the time left until the next halving cuts your revenue in half again. Now, what makes this different from 2018 or 2022 is the nature of the selling. Back then, miners were dumping coins because the price had crashed and they couldn't keep the lights on. But what's happening now is deliberate. These companies are drawing down reserves on purpose to fund a pivot into AI. And that kind of selling doesn't necessarily stop when the price recovers. The incentive to move capital toward AI is there no matter what Bitcoin is doing. And the reason this is all moving so fast is because Bitcoin miners already own the thing Silicon Valley needs most and cannot build fast enough. If you want to set up a new AI data center from scratch, the bottleneck isn't the building or the GPUs, it is the grid connection. Getting a new high-power interconnection permitted and built out takes 4 to 10 years. But a miner who's already got hundreds of megawatts on the grid can swap out their Bitcoin rigs for GPU racks in weeks. Core Scientific signed a 12-year deal with CoreWeave worth over $10 billion.
The same sites that will probably not be profitable for BTC mining in 2028 or 2032 check a lot of boxes for HPC and AI.
Hut 8 got a 15-year, $7 billion lease backed by Google, and by the end of 2025, miners had announced more than $65 billion in AI and high-performance computing contracts. And here's probably why. For every dollar a miner spends running AI workloads, they're keeping 80 to 90 cents as profit. With Bitcoin mining, that number's more like 55 to 65 cents. And because companies like Microsoft and Google guarantee these payments over the life of the contract, banks will actually lend against them. So miners can finance these conversions without putting much of their own capital at risk.
And now it's enabling our shift to hosting high-performance computing.
So it's no surprise that several mining companies have already dropped the word Bitcoin from their names entirely, rebranding as infrastructure and energy businesses. And that tells you everything about where they see their future. So at this point, you might be wondering, if miners are leaving, is the network actually in trouble? Well, remember that Bitcoin has an inbuilt difficulty adjustment feature. Every 2 weeks, the network checks how much computing power is actually out there mining and recalibrates how hard it is to find a block. If a bunch of miners leave, difficulty drops. The ones who stayed earn more for the same work, mining gets profitable again, and new people show up. And we've already seen this under way more extreme conditions when China banned mining in mid-2021. Over half the network's computing power vanished overnight, and Bitcoin recovered completely within 5 months. And despite everything happening right now, the halving, the price crash, miners pivoting left and right, hash rate hit 1 zettahash per second in late 2025, and that is a record, meaning the network is actually getting stronger. Now, it's pulled back since then, but it's still above that mark. The risk that actually deserves attention isn't some dramatic attack. A Duke paper from last October priced that at about $6 billion in years of visible preparation. The real concern is centralization. The top 4 mining pools already control about 73% of hash power, and the US alone accounts for around 40% of all mining. And if the economics keep pushing out everyone except large AI-subsidized corporations, it only gets worse because Bitcoin ends up depending on a handful of companies who treat mining as a side hustle. Now, that said, there is a real argument that this is just a long overdue cleanup of miners who were running on cheap debt, outdated hardware, and never had sustainable economics. As big public companies redirect power toward AI, smaller, more efficient operations are picking up their hash rate share. According to Cambridge, over 52% of Bitcoin mining now runs on sustainable energy, up from 37% in 2022. Coal went from 36% down to under 9%. Companies like Gridless Compute in Kenya, backed by Jack Dorsey's block, run entirely on stranded hydro and geothermal, subsidizing rural electrification with mining revenue. They don't need AI deals because their power costs are basically zero. And this might just be what a healthy mining industry was always supposed to look like. Will AI kill Bitcoin? Well, no, but it might actually be beneficial in some cases. For the first time, miners have a revenue floor that doesn't depend on crypto prices. When your AI contracts cover your fixed costs, you can mine Bitcoin profitably and basically at any price. And on the other hand, smaller, more efficient operations that crop up can help distribute mining power. Now, mining started as a hobby. Cypherpunks running GPUs in their basement. Then it grew into a speculative industrial bet for Bitcoin. And now with AI, it seems it's becoming something else entirely. A global energy infrastructure business where the actual skill is sourcing and delivering high density power. So if the biggest miners are pivoting to AI, does that make you more bullish or bearish on Bitcoin? Well, let us know in the comments below. Bye.